If you're investing your money, you know right now is a very, very scary time because of course your investments are constantly fluctuating. News could come out and it can go down 5 or 10%.
Now, the closing bell rang just moments ago, the Dow down on fresh fears over tariffs as a big tech sell-off gains momentum. So let's take a look at our interactive stock market heat map. This is brought to you by FinViz. This is showing the top 500 stocks. It is a sea of red today.
There's also some good news that could come out and that can also boost your investments up.
Somebody had to do what we did, and I did a 90-day pause for the people that didn't retaliate.
Either way, right now is a very, very scary time to invest your money. Now, there are going to be people that say this time is different. You should just pull all your money out. All of it is going to go down the drain. You should not be investing your money in this time. And what I want to say to those people is you're wrong. Hello everyone, welcome back to another video. My name is Ali. I'm a certified financial planner based out of Toronto. Let's talk about the conditions of the market. So first thing I want to talk about is how this time is different, or at least so they say. In terms of these market conditions, we've seen these market conditions before. Of course, right now there's a lot of political pressures where there's a lot of tariffs that are being imposed on a lot of different countries, primarily coming from the US. The US imposing tariffs on a lot of different countries, particularly China. And of course, there are some retaliatory tariffs that are being imposed on the US as a result of all of these different tariffs that they're trying to impose. This is not the first time that this has happened. Tariffs have been a way to negotiate trade between different countries in the past. This isn't unusual. The thing that makes this a little bit different is the fact that it's a widespread tariff across many different countries. Of course, when there's a lot of political pressures, people start to freak out, and especially when they start to see their investments drop, once they start to see the economy, kind of waver a little bit, they start to panic. They are convinced that now is different and all of the money that you have invested is going to be gone. It's going to disappear. Now, of course, there is always risk when you go to invest your money. However, I want to talk about the top market declines over the last 100 years and talk about how at that time people thought it was different. Of course, we've seen that wasn't actually the case. Yes, there was a little bit of turmoil that you have to go through in those times, but everything did recover, and not only did it recover, but it also boomed after that, where it would grow significantly higher to where it was prior to that. I'm going to use some statistics from the S&P 500. There's a lot of data out there that goes to show the market fluctuations as well as market data when it comes to the S&P 500. Now, of course, with this data, yes, it is primarily for the United States. However, what you can find is the data for other countries as well is going to be very similar. Timelines might be slightly different because, of course, every single market has their own market conditions and they may have their own market declines. Let's go back to 1929, September of 1929. It was the beginning of the Great Depression. For those of you who don't know, the Great Depression was the biggest market decline in history, where the max drawdown from the peak was 86%. Now, one of the things that you can see though is after that timeline, of course, there was a major drop of 86%, but 1 year after the Great Depression was over, the market actually jumped up 123%. And of course, that continued. If you take a look into the next 5 years after that, there was a total return of about 265%. 5 years after the Great Depression. Another big decline that happened, it was in 1987. 1987 was when there was what was called Black Monday. Black Monday was one of the biggest declines of a single day in the markets, and that happened, like I said, in 1987. There was a total of about 3 months where the market continued to decline. And when that declined, it declined a total of 33% between August of 1987 to December of 1987. Now, of course, that was a short period of time where a third of the market just got wiped out. A year after, so in 1988, the markets gained 21%. Now, 21% in a single year for anybody is a very, very good rate of return. Now, of course, that doesn't mean that you got back to the initial point after Black Monday. Now, one of the things that you do want to take a look at though is in that time, if we take a look at 5 years after Black Monday, there was a total return of about 93%. 93% over 5 years. And what's even more impressive is the overall rate of return in a 10-year time period. So after Black Monday, the total return in 10 years was 335%. So that means in 10 years after Black Monday, you would have more than tripled your money by keeping the money in the investments in the market. Now, of course, there were a couple other big ones along the way as well. So there was the dot-com bubble. The dot-com bubble was very notorious for a big market drop because there was a big boom in tech, and then of course there was a big drop in tech, which dropped the market by 49%. After the initial drop of 49% in the dot-com bubble, there was an increase by 34% in 1 year. And then within 5 years, it was actually up 101%. Let's take it back to 2008. 2008 was another big market drop. It was the great financial crisis. In that time, there was a drop of 57%. 57% in a very, very short period of time. After the global financial crisis, once things started to bounce back, you find that after the initial drop, there was actually an increase of 69% in 1 year. And the total return after 10 years was over 300%. Now, of course, we can use the COVID-19 example as well. This is the most recent where there was a big, massive drop. Everybody thought the world was coming to an end. People didn't know what was going on, and everybody was cooped up in their homes. And of course, everybody thought that this was the end.
A Bankstown mother and daughter have been charged after a fight over toilet paper in Woolworths.
Stores in our area are still seeing a spike in hand sanitizer sales.
Hospitals in Canada are burning through masks, gowns, and gloves in the fight against COVID-19.
Turns out it wasn't. However, there was a market drop of 34%. As we can see, since March of 2020, when things started to bounce back, 1 year after the initial drop in COVID-19 in March, the market gained 75%. Now, of course, there was a lot of different conditions as to why this was the case. However, in 1 year, it went up 75%. So these are just some examples as to what's happened in history and how these things have bounced back. Of course, every single one of these situations, there was a lot of different reasons for why the market dropped. And every single time, these are situations where people said, this is it. That's it. There's nothing else we can do. We're gonna lose all of our money. And that hasn't been the case. So this is really a time where you need to just take a step back, take a deep breath, and understand that this is part of the process. Now, I want to talk about why it's important to stay invested, especially in these times when the markets are not doing so well. One of the most interesting facts that I've seen is what happens to your investments if you're out of the market and you miss the best 10 days or the best 20 days or best 30 days of the market in a given period of time. If we take a look at the top days from 1995 until 2024, 50% of the 50 best days in the market actually came during market downturns. It came in the bear market when everybody had a negative outlook on the markets. 25 of the best investing days actually happened in those times. 28% actually came in the first 2 months of the bull market. So essentially what this means is when the markets start to bounce back and now there's more faith in the markets, this is what we consider a bull market. This is the beginning of the rise of the markets. 28% of the top 50 days. So we're talking about 14 of the best investing days in that period of time actually came in the first 2 months of that bull market. And only 22% of the best investing days came when markets were doing very well. When it was in a bull market, when everybody had faith that the markets were going to continue to grow and continue to rise. So if right now you're scared of investing because of the way that the markets are, you're more than likely to miss a lot of the best days when you're actually investing. Based on history over the last 30 years, if you were out of the market during these bad times, you're missing out on most likely up to 50%, if not more, of the best days that you could invest. Say in 1995, you had $10,000 invested. If you were fully invested in the market, then your portfolio in that time, from just the $10,000 invested, would be $224,278. If you missed only 10 of the best days, your portfolio being 54% less than if you were being fully invested. Your portfolio would be $102,750 in that 30-year time period. Now, if you missed the 20 best days, it would actually be 73% less than what it could have been if you were fully invested in that time. So that means that $10,000 would only be worth $60,306 just by missing the 20 best days in a 30-year time period. And what makes things even more interesting is if you missed the best 30 days, your $10,000 would only be worth $38,114, which is 83% less than what it would have been if you were fully invested in the market at all times during that 30-year time period. So in this case, you can see that just by panicking, if you panic and you completely sell and you don't want to be in the markets anymore, missing 1 month of gains over a 30-year period is costing you over 80% of your overall portfolio. This is why it's important to not freak out and jump out of the market and try to time it back in, because you're more than likely going to miss some of the best investing days. So as you can see, there's a lot of different things that can really have an impact on your investments in the long term. If you were okay with your investments when things were doing well 3 months ago, and you're not comfortable with the way that things are right now, then you were probably not in the right thing to begin with. Because at the end of the day, when it comes to your risk tolerance, it's both on the way up and on the way down. You have to be okay with lesser gains when the markets are going up if you want lesser drops when the markets are not doing well. Because at the end of the day, usually the more risk you take on, the potential for higher returns, but there's also the potential for higher losses as well. So one of the things that you should definitely consider is, are you in the right thing right now? Because if you're not comfortable right now, then you are probably not in the right thing to begin with. The best way to determine that is to talk to an advisor, talk to a professional, and they'll be able to help you navigate all of this situation. If the advisor is telling you to completely sell and move into something that's a little bit less risky, I would probably hold off on doing that. I would slowly start to transition from what you currently have over into something that is a little bit less risky, if that is something that you wanted to do. I would not completely switch, because at the end of the day, if you took on the entirety of the drop, you don't want to sell at the lowest point and then have a slower recovery because of those changes. So there you have it, guys. Those are all of the different things to consider. You can see that markets, this is not the first time. This is not the first time that there's been a big drop. It's not the first time that there's been political pressures. And every single time we've seen, the markets have bounced back, even when they've declined as much as they have. Don't get scared of the markets right now. I know it can be a little bit scary. And it's one of those things where you just have to be patient. The more patient you are, the better you'll be long term. Because at the end of the day, if you miss out on just the 10 best days, your investments 30 years from now could actually be half as much as what they could be in 30 years. If you like this video, please leave a like. And also, if you have any questions, please leave those in the comments down below. I'll be more than happy to answer those questions. Also, if you learned something from this video, please share it with your friends and family. At the end of the day, if you learned something from this, I'm sure they will too. And this will also help me continue to build out this channel, to continue making content to make this information readily available. As always, guys, stay safe, take care, and we'll see you guys in the next one.